Welcome to my channel. I'm Scott, and in this video I'm going to walk you through the process of valuing 4 companies. The first is Nike, the second is Deckers, the third is Skechers, and the fourth and last is Crocs. The first company is Nike. They design, develop, manufacture, sell, and market footwear, apparel, equipment, and accessories. It is the world's largest supplier of athletic shoes and apparel. It's also a major manufacturer of sports equipment. Their original name was Blue Ribbon Sports, but they officially became Nike in 1971. The name is based on Nike, the Greek goddess of victory. The company is headquartered in Beaverton, Oregon, and was founded in 1964. Let's get started with the model. This is a large cap company, 159 billion market cap. They're trading at 105 a share, and they have 1.5 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They had low free cash flow in 2020 due to lower sales from COVID. It was 1.4 billion. Then it blew up in 2021, almost 6 billion. It did drop after that to 4.4 billion, then dropping again in the trailing 12 months to 3.8 billion. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's also low in 2020, 2.5 billion. It peaks in 2022 at 6 billion. It's 5.5 billion in the trailing 12 months. Revenue is a sales for the company, and that goes up each year from 37 billion to almost 51 billion. This is their most recent income statement. This is the quarter ending 2/28/23 versus the same time period in 2022. Also the 9 months ending 2/28/2023 and the same time period in 2022. Their most recent quarter, they had revenue of 12.4 billion. That's up from 10.9 billion. I'll give you a breakdown of this number. Of the 12.4 billion of revenue, 8.5 billion in footwear, 3.5 billion in apparel, that's like shorts and sweatshirts, 400 million in equipment, and 61 million in other. Here's a different breakdown of their revenue. Of the 12.4 billion, 6.7 billion is wholesale, 5.6 billion is direct to customer. So the margins are much higher direct to customer. Of the 12.4 billion of revenue, 4.9 billion in North America, 3.2 billion in EMEA, 2 billion in China, 1.6 billion in Asia Pacific and Latin America. And most of their revenue is from their Nike brand, 11.8 billion, only 600 million from Converse. Let's go back to their income statement. Cost of revenue is 7 billion. These are all the expenses directly related to generating the revenue. All the expenses to make the product. The cost of the factory, the materials. Revenue minus cost of revenue gives you your gross profit. That's 5.4 billion, up from 5.1 billion. It was 17 billion in the trailing 9 months. They spent over 900 million in demand creation expense. This includes advertising, TV commercials. It also includes endorsement contracts. When they pay an athlete, they put that expense in this area. Operating overhead expense 3 billion. Selling and admin expenses 4 billion. They had net interest income of 7 million. They might have paid $80 million in interest expense, but received 87 million in interest income. This is the net number. 237 million of taxes, so their net income is 1.2 billion, down from last year of 1.4 billion. So their EPS is 80 cents, down from 88 cents. They are buying back stock. They have 35 million less shares outstanding than last year. Let's look at the capital structure. 14.5 billion of equity, 12.5 billion of debt. They're 54% equity, 46% debt. Their net debt is 1.8 billion. So they have 11 billion of cash on their balance sheet. I gave them a WACC of 9.8%, and that's the discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's 106 billion. We discounted those numbers back to today's and weighted average cost of capital. We get a value of the company of $95 billion. We divide that by 1.5 billion shares. And we get a calculated stock price of $63. They're trading at 105, so they're trading at a 68% premium. It's a sell according to the model. Simply Wall Street's at 85. They say the stock is 24% overvalued. 26 analysts price this stock, and the average price target is 139. The low is 95, the high is 185. Another 33 analysts price this stock, and the average price target is 136. They say the stock is 29% undervalued. This is where the stock has been trading since 95. It is hard to tell on this chart, but it does look like the stock has been steadily growing from 95 to 2012. It was around $25 in 2012. Then by 2015 it doubled to 50. Then 5 years later in 2020 it doubled to 100. Then COVID hit, it fell to about 70. Then the stock blew up post-COVID, hitting about 180 at its peak. It did come down about 60% to about 85. It did break through 125 recently, but it has regressed down to 100. And you can see they've been really consistent with their dividend payment. They pay a quarterly dividend, and it looks like they raise it each year. It was 20 cents in 2018, now it's 34 cents, a yield of 1.3%, which is 54% of their free cash flow, 38% of their net income. So to summarize, I have them trading at a 68% premium. They've been around 59 years. It seems like some stocks, like Ferrari, always trade at a premium. Maybe it's the brand name. People just feel more comfortable investing in a company with a prominent name, even if the financials don't back up the stock price. People say the same thing about Berkshire Hathaway. Warren Buffett's name pushes the stock price higher. The positive thing is you do get your consistent dividend, and they are the largest shoe company in the world. I rank their free cash flows 4 out of 10, their revenue 7 out of 10, and their ratio is 3 out of 10. The second of the 4 companies we're going to look at is Skechers. Skechers is a footwear designer and distributor. It sells UGG, Teva, and many more brands. You can find its products in more than 50 countries. It has 138 company-owned and operated retail stores, as well as an online presence. The company is headquartered in Goleta, California, and was founded in 1973. Let's get started with the model. This is a large cap company, 12 billion market cap. They're trading at $4.75 a share, and they have 26 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow doubled from 2020 to 2021, $560 million. It dropped a lot in 2022 to $121 million. Then it went up about 300% to $456 million in 2023. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that grows each year from $276 million to $517 million. Revenue is the sales for the company, and that also goes up each year from $2.1 billion to $3.6 billion. This is their most recent income statement. Their year ends in March, so they've completed their 2023 fiscal year. This shows us 2021, 2022, and 2023. Revenue in 2023 is $3.6 billion, up from $3.15 billion in 2022, up from $2.5 billion in 2021. Let me give you a breakdown of the $3.6 billion so you know what it is. UGG is their biggest brand. Revenue of $1 billion. That is down from 2022 of $1.1 billion. Hoka is a close second at $926 million, up a lot from $629 million. The way you pronounce the full name is Hoka One One. The shoe originated in France, but now it's part of this company. Teva is third at $149 million. Then a distant fourth is Sanuk at $28 million. All other brands is $54 million. These numbers were just their revenue in wholesale, but they do a lot of revenue direct to consumer, $1.5 billion. You can see how much better the margins are for direct to consumer. $1.5 billion of revenue, $500 million of profit. So about 1/3 of their revenue is profit. When you look at UGG, it's 27% of their revenue is profit. The margins are much higher when you sell directly to the customer, because when you sell wholesale, the wholesaler, the middleman, takes a cut. They actually lost money on the other brands. Revenue of $54 million, a net loss of $1.7 million. Let's go back to the income statement. Their cost of revenue is $1.8 billion. These are all the costs directly tied to making the products. Revenue minus cost of revenue gives you your gross profit, $1.8 billion. That's up from prior years. Then you have SG&A, like marketing expenses would fall in SG&A. Their operating income is $650 million. They received almost $16 million of interest on their investments. They paid $3.4 million of interest on their debt. They had a loss of $1.2 million in other. Income taxes of $149 million. Net income of $517 million. That's up from $450 million last year and $380 million a year before. So their EPS looks really good at $19.50. Last year was $16.43, before that $13.64. And they are buying back stock. In 2021, they had 28 million shares outstanding. 2022, 27.5 million. And in 2023, 26.5 million. Let's look at the capital structure. $1.8 billion of equity, $240 million of debt. They're 88% equity, 12% debt. And they could pay off all the debt with the cash on their balance sheet and still have $735 million of cash left over. I gave them a WACC of 10%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated the terminal value, which is all cash flows past year 4, that's $12 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $10.6 billion. We divide that by 26 million shares. And we get a calculated stock price of $406. They're trading at $475, so they're trading at a 17% premium. It's a sell according to the model. Simply Wall Street is at $175. They say the stock is 171% overvalued. 10 analysts price this stock, and the average price target is $541. The lowest $480, the highest $610. Another 16 analysts price this stock, and the average price target is $528. They say the stock is 11% undervalued. This is where the stock has been trading since 95. It looks like it was pretty low from 95 until 2005. It is really hard to tell on this chart because it's so many years. The stock was doing well in 2010, so they did a split. It broke through $100 for the first time in 2011. And then over the next 2 years, it came down about 60%. Looks like it was around $40, $45 at the end of 2012. Then about 2.5 years later, it hit 100 again, then declined throughout 2015, and it took until 2018 to get back up to 100. It doubled from 2018 to 2020, then COVID hit, the stock went down 50% to 100, and then there was a huge bull run, well past $400. And that was in the beginning of 2021. Then it came down to 250, then the stock just shot up again. It's getting close to $500. It's trading pretty close to its all-time high. So to summarize, I have them trading at a 17% premium. They've been around 50 years. The stock price is doing amazing. So I could see it's hard to buy it right now because you missed out on all the gains. But you can't look at the past. You have to look at the future. Would you buy the stock now based on its price and its historical financials? And of course, the potential growth in the future. Whether the stock is up 500% in the past few years or down 80% in the past few years, you just have to look at what it's trading at today. I ranked their free cash flows 5 out of 10, their revenue 6 out of 10, and their ratios 4 out of 10. The third of the 4 companies we're going to look at is Skechers. Skechers is the third largest footwear brand in the US. Its brands include Skechers Sport, Slip-ins, and D-Lights. It was founded by Robert Greenberg, who had previously founded LA Gear in 1983. He stepped down as CEO of that company the same year he founded Skechers. The company is headquartered in Manhattan Beach, California, and was founded in 1992. Let's get started with the model. This is a mid-cap company, $7.9 billion market cap. They're trading at $51 a share, and they have 154 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They did have a small amount of free cash flow in 2020, 22 million. Then it became negative in 21 and 22, but it's back to positive, 267 million in the trailing 12 months. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that grew a lot from 2020 to 2021, cut in half in 2022, increased a little in the trailing 12 months to 483 million. Revenue is the sales for the company, and that grew a lot from 2020 to 2021. Then it increased a bit into 2022 and the trailing 12 months. It's currently 7.6 billion. Here's their most recent income statement, first quarter of 2023, first quarter of 2022. Their revenue 1Q23 is $2 billion, up from $1.8 billion. I'll show you a breakdown of this number so you know what it is. Of the $2 billion of revenue, $440 million is domestic wholesale, $300 million is domestic direct to customer, $850 million international wholesale, $400 million international direct to customer. So they do more business outside the US, $1.3 billion, compared to inside the US, $740 million. Revenue in Americas, North America and South America is $945 million, Europe, Middle East and Africa, $530 million, and Asia Pacific, $520 million. Below revenue is cost of revenue. These are all the expenses directly related to generating the revenue. All the expenses to make their products as part of cost of revenue. Revenue minus cost of revenue gives you your gross profit, $980 million, up from $820 million. Marketing expenses, $128 million. General and administrative expenses, $626 million. So their operating expenses, $755 million. Operating income, $223 million, up from $175 million. They had $10 million of other income, $43 million of taxes, so their net profit, $190 million, up from $136 million. Their EPS is $1.03, up from 78 cents. They bought back about 850,000 shares. They had $156 million. Now they have $155 million. Let's look at the capital structure. $3.7 billion of equity, $1.7 billion of debt. They're 69% equity, 31% debt. Their net debt is $850 million. So they have about $850 million of cash on their balance sheet. I give them a WACC of 10.8%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4, that's $8.2 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $7.2 billion. We divide that by 154 million shares. And we get a calculated stock price of $47. They're trading at $51, so they're trading at a 10% premium. It's a sell according to the model. Simply Wall Street is in the other direction as me. They're at $81 a share. They say the stock is 37% undervalued. 9 analysts price this stock, and the average price target is 56, the lowest 48, the high is 65. Another 12 analysts price this stock, and the average price target is 59. They say the stock is 14% undervalued. This is where the stock has been trading since it IPO'd in '99. A few months after they started trading, it looks like it was down about 50-60%. It was only about $2 or $3. Then over the next year, it shot up to about $13-14. Then the dot-com crash, and the stock came down to about $4 in 2003. And then over the next 4 years, it ran back up to about $11-12. Almost at its all-time high, up to that point. Then it started coming down in 2007, then the Great Recession, and the stock came way back down to about $3-4. It's really a roller coaster ride, this stock. Then over the next year, it ran up to its all-time high, about $13. Then over the next 2 years, it came back down to about $5. But starting in 2014, it had a massive run-up from $10 to $50 in 1 year. So it went up 400% in 1 year. It went from 10 to 50. Some people think that's 500%, but it's not. It's 400%. They did a stock split in 2016. Then over the next 2 years, it fell to below 20. Then from 2016 to 2020, it looks like a heart monitor, up and down, up and down. It finally broke through $50 again at the end of 2020, peaking at $60 at the very beginning of 2021. Then it fell to the low 30s by the beginning of 2022, but it has come up past $50 throughout 2022. So it's trading about 10% below its all-time high. So to summarize, I have them trading at a 10% premium. They've been around 31 years. They have a pretty good brand, and their revenue consistently grows, especially from 2020 to 2021. They had a huge jump. I ranked their free cash flows and revenue 6 out of 10. Their ratio is 5 out of 10. The fourth and last company we're going to look at is Crocs. Crocs is a footwear company that manufactures and markets the Crocs brand of foam clogs. The shoes are made in a variety of styles and colors. Its classic styles are available in more than 30 colors. The company is headquartered in Broomfield, Colorado, and was founded in 2002. Let's get started with the model. This is a mid-cap company, 6.7 billion market cap. They're trading at $112 a share, and they have 60 million shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Their free cash flow more than doubled from 2020 to 2021, then pretty steady going into 2022, jumped up a bit in the trailing 12 months to almost $600 million. Net income is the profit or loss on the income statement. It's revenue minus expenses. And that more than doubled from 2020 to 2021. It dropped in 2022. It's up to over $600 million in the trailing 12 months. Revenue is the sales for the company, and that grew about 80% from $1.4 billion to $2.3 billion. Then jumped up to $3.6 billion. Then increased a little to $3.8 billion in the trailing 12 months. Here's their most recent income statement, the first quarter of 2023 versus the first quarter of 2022. They had revenue of $884 million. Let me give you a breakdown of that number. Their Crocs revenue is $650 million, Hey Dude $235 million. More than half their Crocs revenue is in North America, $140 million in Asia Pacific, and $157 million in Europe, Middle East, Africa, and Latin America. Of the $649 million of revenue for Crocs, $410 million is wholesale, $238 million direct to customers. For Hey Dude, $167 million wholesale, $67 million direct to customer. Crocs acquired Hey Dude in 2021 for $2.5 billion. And the revenue for Hey Dude has been growing a lot. In 2022 it was almost $1 billion. The CEO said in 2023 they should exceed $1 billion. Below revenue is the cost of revenue. These are all the expenses directly related to generating the revenue. So all the expenses to make the shoes, the cost of the factory, the cost of labor, the materials for the products, that's all part of cost of sales. Revenue minus cost of sales gives you your gross profit, $476 million, up a lot from last year of $324 million. SG&A, selling, general, and administrative expenses. This includes payroll for marketing, HR. That's $240 million. So operating income, about double of last year's number. It's now $235 million. They are adding a lot of debt. Last year they had $19 million of interest on their debt. Now it's $42 million. Their taxes were $42 million, so their net income is $149 million, more than double last year. EPS of $2.42 compared to $1.22, and they are adding more shares. Last year was 60 million, now it's 62 million shares outstanding. Let's look at the capital structure. $1 billion of equity, $2.5 billion of debt. They're 28% equity, 72% debt. Their net debt is $2.4 billion. That means they only have $125 million of cash on their balance sheet. I gave them a WACC of 10.5%, and that's a discount rate we're going to apply to the future cash flows. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4. That's $11 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $10 billion. We divide that by 60 million shares. And we get a calculated stock price of 163. They're trading at 112, so they're trading at a 31% discount. It's a strong buy according to the model. Simply Wall Street's at 244. They also say the stock is undervalued, 54%. 7 analysts price this stock, and the average price target is 159. The low is 134. The high is 185. Another 10 analysts price this stock, and the average price target is 155. They say the stock is 38% undervalued. This is where the stock has been trading since they IPO'd. So it looks like they started in 2006. And the stock had a huge run in the beginning, hitting about $75 in 2007. Then the Great Recession hit, and the stock bottomed out at about $5, its lowest point ever. Imagine getting at $5, then 12 years later it hits almost $200. But the stock was nearly $200, then it fell below $50 in a matter of 1 year. It did get close to $150 recently, but it came back down, sitting around $100. There are 14 companies in the same industry as Nike, Deckers, Skechers, and Crocs. And if they have a number in red, they're worse than the median. If they have a number in blue, they're better than the median. All 4 companies spend more than the median in CapEx. Nike spends the most by far, over $940 million. CapEx are investments in property, plant, and equipment. When they buy a warehouse to make more shoes, the cost of that warehouse is put onto their balance sheet and depreciated over its useful life. Crocs is the most leveraged of the 4 companies. For every dollar of equity, they have $2.60 of debt. So it looks like they're using debt to scale their business. And it looks like they're doing a good job because they're growing at 29%. Nike is the only company out of the 4 that pays a dividend. A bunch of smaller footwear companies pay a dividend. Waco pays the highest at 3.5%. All 4 companies generate positive free cash flow. Nike is the most by far. If you sum up the market caps for the other 13 companies, Nike's is much larger than all 13 combined. Deckers is second largest at $12.4 billion. Skechers is 4th largest and Crocs is 5th largest. Price to book is market cap over equity or market cap over book value. Skechers has the best at 2.1. Crocs has the best PE of the 4 companies at 10.3. Crocs also has the best price to free cash flow of the 4 companies we did. And Skechers has the best price to sales. It's 1.0, so that means their market cap is almost equal their revenue. And Crocs is growing the most. Their 5-year annual revenue growth rate is 29%. Deckers is 14%. Nike's only 7%. To summarize, I have them trading at a 31% discount. The company's been around 21 years. They do offer a really unique shoe. And it seems to be catching on because they are growing pretty successfully. I rank their free cash flow 6 out of 10, their revenue 7 out of 10, and their ratio is 5 out of 10. Let me know what you think. Leave a like, subscribe, or comment below. If you want to be a member, you can click on the link in the description below. Thanks for watching.